been a freaky Friday for markets, and a global sell-off is what is spooking Indian markets as well. Before we get to what happened all day today, let me just take you through what's happening in the US markets at this point. The Dow Jones down about 450 points, nearly 1.5% in the red. The Nasdaq also in the red at 0.25% down. Down about 77 points. The S&P 500 also in the red, nearly a percentage point down. Now this is of course looking better than what it was yesterday, and that sell-off in the US markets spread across the world really. So India also joined in that global sell-off in equities, backed by hardening bond yields, and that fear has really sustained. The Sensex dropped nearly 2,000 points in trade today. Nifty fell over 550 points, and the worst hit was Bank Nifty financials. The Bank Nifty in fact ended nearly 5% down. So the question now is, what happens next? Is this a trend that we will see continuing over the next few weeks? Are these high bond yields pushed by concerns of hardening interest rates and a faster than expected improvement in the economy going to spook equity investors even further? And what is the Indian context? We're going to try and understand this evening, and joining me in that endeavor are Nilesh Shah, MD of Kotak AMC, B. Prasanna, Trading and Research, ICICI Bank, Ben Emons, MD of Medley Global Advisors, also joins us on the show. Welcome to all of you, and thank you so much for speaking with us today. Let me go across first to Ben Emons just to get a sense of what's happening in the US markets today. Ben, are we seeing a continuation of the kind of spooked investor behavior in equities that we've been seeing due to hardening bond yields?
We could see a little bit of that going forward, because bond yields still have to normalize back to where we came from pre-pandemic, and we're still in the stage of that the pandemic is here, but it's moderating, and because we're bringing more and more vaccines online here in the United States and we're rolling it out quite aggressively, there's an expectation in both the bond market and the stock market that the economy may be at an inflection point of acceleration in the second half of this year. And as that acceleration takes place, yes, it should lead to higher bond yields, and that will be temporarily at least a negative for the equity backdrop. But I will say though that once we get a little bit through this rising yields, there will be a lot of value opportunity again in the equity markets, because we will have a very strong US economy this year.
How will that impact global equities? Just to follow up there from you, Ben, we've seen US equities spooked by that idea that the Fed will have to really change its stance if you have a stronger than expected or a sooner than expected rebound in the US economy. How do you see global markets responding in that sense, and India as well?
There is a spillover effect, and that's what we're seeing actually overnight. As you mentioned, your market in India was down about 3.5%, but it was actually across Asia. And again, Europe today is very weak, and US opens weak. So there is spillover, so to speak. But it is not clear if this is actually related to what the Fed will do, rather than that investors just pull forward the expectation that at some point all of this policy dynamic will change. And as a result, then the Fed will have to adjust its policy too. So I think we're currently in a very technical situation. It's more driven by liquidity. That is maybe not as good at the moment. People are a bit sidelined and watching this and this volatility. At the same time, the fundamentals improve, yet the inflation backdrop, which people are so worried about, actually showed today is still very benign. The core PCE data that came out in the US today was at 1.5% year on year, and that's what the Fed is watching. That's a very benign inflation reading. So I think it's just really more of a technical liquidity situation currently in the markets than a fundamental story.
Let me go across to B. Prasanna to understand this. And Prasanna, if you can tell us very simply, that why do you think Indian markets behave the way they did today? What was spooking them? Is it all to do with only US bond yields?
So there are two things. So if you have to talk about Indian markets on the fixed income side, things are happening with respect to the kind of supply that's hitting the Indian fixed income markets, and also the realization that RBI might not have the same kind of firepower that they had last year when they were managing their borrowing program. So that's one part of the story where the Indian bond deals are kind of reacting to the extra supply that was announced in the budget. As far as your question is concerned on the rest of the equity markets as well as the global asset allocation, which is concerned. So I think what's happening in the global markets is a little bit realization that, like the previous speaker alluded to, that this is going to be a year in which there is going to be a substantial positive growth rate from the US. And there is also going to be a substantial amount of fiscal stimulus that the Biden government has actually announced. Along with that, there's substantial pickup in inflation expectations that's going ahead. So if you really look at the break-even 5-year and the 10-year inflation expectations derived of the nominal and the real yields in the US, you will realize that the market has already started pricing inflation much in excess of 2.25% to 2.5% over the next 5 years and 10 years. It's not been the case in the last very many years. And add to that also what's really happening is that a lot of mortgage lenders who have actually hedged the negative convexity in their loan portfolio by actually buying 10 US treasuries, actually now coming and selling, because as interest rates go up, they really don't need that hedge anymore, so they're selling it off as well. So to cut a long story short, what's really happening in the bond markets abroad is repricing of the interest rate trajectory over a longer period, and the understanding demand and supply environment for the US bonds is not as favorable as what it was earlier. The Fed has announced that they are going to be controlling the short end of the short end, which is what the powers to do. They have not yet announced a yield curve control as far as at least the US is concerned. So the market really actually testing the Fed's resolve as to whether how far will the Fed go in terms of controlling rise in interest rates. And that's really the battle which is going on between the bond markets and the US Fed globally.
Nilesh Shah, I want a forward-looking comment from you. So now we've seen what's happened today. US markets are open, looking pretty stable, but in the red now once again. What is the outlook for Indian markets next week?
I don't know about next week. I don't think so anyone knows about next week with authority, but I can paint a picture over medium term. One, while interest rates are rising and inflationary pressures are building up with rising crude prices, the corporate earning of India has definitely turned around. September quarter profit was double that of June quarter, which was impacted by lockdown. In December quarter, earnings momentum have sustained. We are seeing now the widest ever divergence between trailing PE ratio and forward PE ratio. If corporate earning power sustains like September and December quarter, no matter what happens in the world, Indian equity market will continue to rise.
What we can also wonder, and what equity investors are also probably wondering, Nilesh, is this a time for correction in Indian markets? Are we seeing then in that case high valuations and the froth really coming to the fore, or are we going to see this sort of tantrum wear out in the next few weeks?
I don't think so. There is too much of frothiness in the market. People who have sold equity are saying that markets have become expensive, but people who have bought equity have recognized what is the earnings growth we have seen in corporate India. There are companies across various sectors which have shown 100% profit growth in September quarter as well as December quarter. As I mentioned, on a trailing basis, equity market appears to be trading between 35 to 40 times. On a forward basis, it is trading between 20 to 25 times. So I wouldn't say that Indian markets are frothy. I will say that Indian markets are probably poised for better earnings growth as witnessed in September and December quarter. Mind you, both in September and December quarter, corporate India suffered negative sales growth, and despite that, they improved margin. and delivered year-on-year profit growth. With GDP turning positive in December quarter, there is hope that March quarter sales growth will be higher. If corporate India continues to deliver profit growth, valuations are becoming cheaper, valuations are not becoming expensive. And in a world where, despite recent rise in interest rate, liquidity remains abundant, interest rates remains low from a historical point of view. They are rising, but they are still low from historical point of view. In this kind of scenario, Indian markets will prove to be oasis among the desert. The earnings growth of India will attract capital from India as well as from abroad. And I will dare say that Indian markets are not frosty at all.
Okay, we'll have to wait and see how the next week goes. Indian markets overall, if you go to see, have everything going right for them. The GDP data that has come in today is another step in the right direction as well. Thank you so much to all of you for joining us on The Big Story this evening.